The broadcast is now starting. All attendees are...
Welcome everyone to applying Elliott Wave to picking winning stocks. Just a quick introduction of myself. My name is Garrett Patton. I am a senior analyst at Elliott Wave Trader. If you guys haven't heard of our site or haven't checked us out yet, we offer a free 15-day trial without any credit card required, ElliottWaveTrader.net. If you want to come check us out after the webinar is over, please do so and check out what we have to offer. I'm also one of the co-hosts of one of the services on our site, which is called Stock Waves. I co-host it with my colleague, Zach Manis. And basically, we cover a wide array of different stocks, I would say in the hundreds to be exact, and maintain a coverage list based on those stocks of which ones we think offer the best opportunities, as well as take requests. We actually just added a new feature to the service where you can type in your own symbol and we will reply with a personalized chart to your request if you're looking at a specific stock that we aren't covering or just want a quick update of one that we do regular coverage on. So again, ElliottWaveTrader.net, come check us out, but let's go ahead and get into the webinar. All right, so what we're going to discuss today, do a brief introduction to Elliott Wave theory. If you guys are new to Elliott Wave, you've never dived into researching it at all, haven't had any experience with it, this is again just a very brief introduction. It's really not going to cover all the information you'll eventually need to apply it in your own trading. So I do recommend, if you're interested in it, that you go out and do a little bit more research. We have tons of educational materials on our site, but there's tons of free stuff out there already if you want to find it elsewhere. So after that, then we'll discuss what qualities we look for when picking the right chart. Basically, we're trying to set ourselves up for success when trading. And there are a number of different things we can look for on a chart that will help best increase those odds for success. So we'll go over those, and then how to apply Fibonacci pinball to that chart once you found one that you think offers a good opportunity, and then based on that Fibonacci pinball, develop a trading plan to hopefully profit off of that chart that you found. So let's jump into it. So first, let's talk very briefly about the theory behind Elliott Wave. So Elliott Wave theory postulates that social mood is driven by unconscious and endogenous forces, basically inside forces rather than outside forces, and the social mood fluctuates in repetitive and fractal patterns. So social mood is what governs the character of social events rather than social events being largely random or the result of external forces. So this idea that pretty much the majority of economists and traders and investors alike have adopted is basically, some news event will hit the wires and then the market reacts, and it's based on that news event, whether or not we trade to the upside, trade to the downside. Basically everything is random or waiting for some sort of external catalyst to react to, and that's how the market makes movements up and down. This is kind of a very different approach to the market, where the idea is that basically overall social mood, our collective social mood together, is more subconscious, driven by endogenous forces, and therefore coming from within. And really these patterns throughout history of human behavior repeat themselves over and over, and we can see them in the stock market and kind of these swings up and down based on social mood, the business cycle, etc., are therefore basically able to be tracked or forecasted ahead of time based on those patterns. So periods of positive social mood result in rising stock prices, re-election of incumbents, the economic expansion. Periods of negative social mood result in declining stock prices, rejection of incumbents, and economic contraction. Pretty straightforward there. If social mood governs social events, then what governs social mood? The answer there is the wave principle. So what is the wave principle? Basically, the wave principle is that same idea. Social mood follows repetitive and predictable patterns that can be measured and tracked using financial markets. Basically, the fluctuation of stock prices is the result of changes in social mood. So when positive social mood is waxing, then basically economic expansion happens. People will be buying stocks because they're optimistic about the future, and the reverse goes for when negative sentiment is on the rise. So trends and corrections of stock prices link together to form distinct self-similar patterns, and these patterns basically repeat themselves over time at various different scales of price. And the self-similar patterns reflect the most efficient way of achieving both progression and fluctuation over time. And in the same way that phi, the golden ratio, governs relationships and natural phenomena involving growth and decay, expansion and contraction, and the advancement and retreat, the progression and fluctuation of stock prices also exhibits Fibonacci relationships. So this will be a kind of quick idea of the difference between the standard view of economics, financial markets that I'm sure you guys have all heard of and were taught, as opposed to the opposite socioeconomic hypothesis. So the standard view is that a recession is what causes businessmen to be cautious. The opposite view from socioeconomic perspective is that cautious businessmen are what cause recession. Standard view, talented leaders make the population happy. Socioeconomic view, a happy population is what makes leaders appear talented. Standard view, company earnings determine investor opinion. Investor opinion is what will eventually determine company earnings based on that overall sentiment. Epidemics cause people to be fearful and depressed. Depressed and fearful people are susceptible to epidemics. A rising stock market makes people optimistic. Optimistic people make the stock market rise. Scandals make people outraged. Outraged people make scandals. We can continue to go on, but basically you get the idea that rather than this cause and effect that's driving prices, people are reacting to external events, external causes. Really, the overall repetitive patterns of social mood are what are causing those patterns to begin with. So they're all kind of coming from the same source and not necessarily a direct cause and effect. All right, so let's get into how that is reflected in financial markets. So that brings us to the basic pattern of Elliott wave theory. And as you can see, that is 5 waves up, 1, 2, 3, 4, and 5, followed by a 3-wave corrective pullback. So market progression unfolds in waves, and these waves are patterns of directional movement. Trending moves unfold in 5 waves, and they are regarded as motive. So moves that basically progress the trend, price and the trend of the larger, the direction of the larger trend are motive waves, and the counter trend interruptions that unfold in 3 waves are regarded as corrective. Motive structures are labeled with numbers, while corrective structures are labeled with letters. So as you can see here, 1, 2, 3, and 5 for the 5 waves up in the motive structure, and then an ABC for the corrective pullback. These patterns are also fractal in nature. So you can see now what looks a little bit more like a price chart from a financial market with a little bit more fluctuation in there. And as you can see, if you look at the labels, that initial 5-wave move up that makes up wave 1 of the larger 5 waves itself breaks down into 5 waves. So all of the moves that are progressing price in the direction of this upward trend are also going to be motive because they are progressing again price in the direction of that trend. So they will be breaking down into 5 waves. So the actionary waves of that larger structure, waves 1, 3, and 5, will also subdivide it into 5 waves. And then those periods of corrective interruption are going to be 3-wave moves, the same corrective moves. If you look, even though this larger ABC down is a corrective wave itself, if we're looking at that smaller degree trend to the downside, you'll see that those waves progressing price in the direction of that trend are 5 waves, motive waves. So basically that distinguishes the 2 purposes of those 2 structures: motive, progressing price in the direction of the trend at 1 higher degree; corrective, obviously correcting price in the direction against that direction of the trend at 1 larger degree. So basically this overall 5-3 pattern is the overriding form of market progress. All other patterns are subsumed by it. The fractal nature, which I just spoke of, repeats across all scales of time and price. And the compound construction builds on itself to form different degrees of the overall 5-3 structure. So again, you can see that if we were to zoom out and let this progress further, this larger 1-2 here could be the same as this 1-2 right here, and unfold in a wave 3 next, and then a 4th and 5th to be followed by that. And if you were to zoom in further and take a look at this wave 1 here, it would look like this same 1-2 structure. So that fractal nature at varying different scales of time and price hopefully is illustrated there. So at this point, you may be asking yourself, why 5-3? Where did those two numbers come from? Why are all patterns subsumed by this 5-3 structure? So the basic idea behind that is it is the minimum requirement for achieving both fluctuation and progress, which we all know exists in financial markets. So one wave doesn't allow for fluctuation. The fewest subdivisions to create fluctuation would be 3 waves. 3 waves in both directions, though, would not allow progress. So at least 5 waves are needed to progress price in one direction, despite the periods of regress, simply to cover more ground than the intervening 3 waves. So while it's possible there could be more than this 5-3 structure, the most efficient form is 5-3, and nature typically follows the most efficient path. So that's how we get that 5-3 structure, allows for fluctuation and progress in financial markets in the most efficient manner. So now we've kind of covered the very basics of Elliott wave theory, and again, I apologize for that being a very rudimentary introduction. Again, if you aren't familiar with it all, especially the individual patterns that make up, especially corrective waves, the motive waves are fairly straightforward, just 5-wave structures, but again, corrective waves, to navigate those, you'll need to look into those patterns in a little bit more detail. Again, plenty of educational materials out there, though. So let's get into actually applying this, though, to our trading. So what we want to do next is be able to pick the right chart based on Elliott wave theory and our understanding of how financial markets move on those patterns. So what you want to be looking for is, are you trading with the trend? Basically trading a motive wave rather than a corrective wave. So of course it's possible to make money during corrective periods of the market where you're taking basically a counter trend trade, trading against the larger trend. We're trying to set ourselves up for the best possible chances of success, and trading with the trend is, as I'm sure as you've heard before, is much easier, much more forgiving if, say, you don't have the perfect entry or the perfect exit as far as being successful with that trade. So remember, the trend is your friend, much easier to trade with the trend, much easier to trade a motive wave. So once you understand Elliott wave theory and you can identify when a motive wave should follow next in the pattern, that's the type of pattern that you want to be trading rather than trading a corrective wave. So you don't want to be trading wave 2s or wave 4s. You basically want to be trading, ideally, a third wave, since that's usually the strongest portion of a motive wave. Next, you want to ask yourself, is there a clear Elliott wave count? There are going to be charts out there that either, one, don't have a very established trend, they're choppy, move up and down, sideways over several months or years, etc., and basically don't really lend themselves as well to Elliott wave theory or trend trading for a more simplistic view. That's not necessarily translating into it being a bad chart to trade. There are certainly trading strategies out there that are great in choppy markets, great in markets that aren't moving very much, but we're talking about basically setting up a nice trending trade, directional trade, where you're looking for a big move in the market and hopefully profiting off of that. So is there a clear Elliott wave count that you can apply to the chart that you have confidence in, that you can then apply Fibonacci pinball to and start to trade? Next question you want to ask yourself is, does the setup match your desired trade duration? So one of the things that I've noticed a lot with some of our members on our site is they see a setup on a chart, or we introduce a setup to them, and they focus on a different time frame than the expected setup is kind of being illustrated as. So it may be a trade that, or a move that's expected to happen over several months, for example, and they're looking at 10-minute, 5-minute, 1-minute charts, worried about those very smaller degree gyrations within the pattern rather than focusing on the bigger picture. So if you're somebody who's more interested in trading those smaller time frames, quick in and out trades, day trading, not staying in the market for very long or trades for very long, Elliott wave theory, Fibonacci pinball can certainly still be used in your trading, but you have to recognize that that's the time frame you're trading, and vice versa. If you're looking at a pattern that is a much higher degree, much longer term duration, make sure that you design your trade and you're really focusing your energy on that same time frame that the pattern is suggesting it's going to be playing out on. So if you're a short-term trader, then you're focusing on the very smaller degree patterns. If you're a longer-term trader, you're looking at those bigger degree patterns that can take several weeks, months, even years to fill out. The last question, actually I think I have one more after that. The next question, did the trade parameters match your risk appetite? So another situation is that you'll see what looks like a great trade setup, especially because the projected upside percentage gain for that trade is really attractive. 100%. It's going to be double, triple, quadruple, whatever the amount is. But at the same time, when you pick your stop, how much are you risking based on that stop using that same setup? A lot of times, if the projected upside is pretty substantial, then the stop that you're going to be using where that pattern invalidates can also be somewhat substantial because it's a very volatile chart. So does that kind of match your trading strategy? Are gyrations, daily gyrations of 5 to 10% going to be too stressful for you? Are you better suited for a chart that's a little bit less volatile? These are questions that you should ask yourself so that you set yourself up again for the best chances of success. And then the last question you should ask is the stock liquid enough? Is it optionable if you're going to be trading something aside from shares, like options, if you're going to do calls or puts or whatever option strategy you want? Obviously, you want to make sure the chart is optionable and there's decent open interest in those options that you can successfully get in and out of the trade when you need to. If the stock isn't very liquid, then the chances of kind of large moves that can be surprising increase, and I wouldn't necessarily say invalidations of patterns are more likely on illiquid charts, but you'll see a lot more spikes that could end up hitting stops, even though they're still cooperating within expectations overall of Elliott wave theory. You can get a big quick spike that hits your stop, you're out of the trade, even though it reverses right after that and goes back to expectations. So just something to consider. So once you found a chart that kind of meets all these criteria, then we can start to apply Fibonacci pinball. But let's just take a look at this right here to get an idea a little bit better of those time frames that you'll be looking at, and which portion of the trend you're going to be trading. So again, you want to be trading the motive waves here, the portion of the structure that is going to be progressing price in the direction of the larger trend. And it doesn't really matter what degree. Again, you can trade just this third wave within a third wave. You can trade the entire 1, 2, 3, 4, and 5 at the higher degree. It really depends. But again, you have to recognize at the beginning of the trade what you're aiming for, what your goals are, and then design the trade around those goals. So again, you want to be trading the motive patterns, the ones that are progressing price in the direction of the larger trend. Oops, whoops, I didn't mean to switch slides yet. So that doesn't necessarily mean that the larger structure has to be motive itself. As we discussed earlier in the webinar, within a larger corrective structure, you do still often have motive waves within that corrective pattern to progress price in the direction of that degree, the trend of that degree. So even though this larger three-wave move itself is corrective and going against the bigger trend here to the upside, you still at a smaller time frame can trade these smaller degree motive waves that are progressing price in the direction of this corrective wave. Up to you. I would still say that those setups are a little bit less desirable because the larger trend is still fighting. It's still fighting against that larger trend. Sometimes you'll see variations because of that in the corrective structure. Corrective structures to begin with are already more variable. So usually you want to be trading in a larger impulse in the direction of the larger trend, but not impossible, for example, to trade maybe a C wave of a correction or something like that. All right. So next, let me switch over here. Let's go ahead and take any questions real quick before I move on to Fibonacci Pinball, since this is a nice transition point. Yes, the webinar will be recorded, and I do believe you will be emailed a link to that recording. Next question from Sergio. He asks, can a corrective wave go beyond C, or does it turn into a new trend after C? So a corrective wave, it depends on what corrective wave you are referring to. Let me go back to this slide here, just so that I can illustrate it. So you should see that picking the right chart slide again. So imagine for me that the labels here of a 1, 2, 3, 4, and 5 are on the chart. And you're asking, can this wave C, can a corrective wave go beyond C? So in order for a 1, 2, for example, to be valid, the wave 2 here cannot exceed the starting point of wave 1. Otherwise, that invalidates it being a 1, 2 to the upside. So there are certain rules, and again, this is where you'll have to dive a little bit deeper into Elliott wave theory and the rules and guidelines behind it to understand and become familiar with, but there are certain rules that need to be followed by the corrective structures in order to apply a correct Elliott wave count to it. So, for example, in an impulsive structure, the fourth wave cannot overlap into the price territory of wave 1. Wave 2 can't trade below the starting point of, or the origin point of wave 1. Wave 3 cannot be the shortest wave. There are just certain things that you need to be familiar with, and then make sure that your counts are obeying those rules and guidelines. So hopefully that answers your question. Next question, how do we spot a change in trend? What you're looking for is, one, does the structure of the previous trend look complete? So let's say, for example, you are pretty clearly dealing with an impulsive structure. You have a strong trend to the upside, it looks impulsive, there's not a lot of overlap in the price structure, etc. Does it look like that price structure has completed 5 waves? So if you're, say, right here in the pattern, it looks like only 1, 2, 3 waves into that. So the expectation would then be that another 4th and 5th will follow, and then you will see that change in trend. So again, you're kind of trying to identify where in that larger 5-3 basic pattern of Elliott wave theory price is currently at. And based on that, you can try to predict when the pattern will complete and the next larger degree structure, whether that's corrective or impulsive, and a change in trend is going to occur. And then, and we'll take a look at this in a second, you can also use Fibonacci Pinball to kind of increase those odds of identifying when that motive pattern has completed or that corrective ABC has completed as well. One of the things I look for a lot, though, is basically, let's say on the last 5th wave, so this would be the 5th wave right here of a larger 1, 2, 3, 4, and 5 up. When price breaks back below the 4th wave at one lesser degree, so again, this 5th wave itself divides into 5 waves. When it breaks below that 4th wave of one lesser degree, that's usually my first confirmation level of the change in trend. So once this low was taken out, that confirms that the corrective pullback is begun, and the fifth wave top is indeed in place there. Van Dio, next question asks, would waves 2 and 4, for instance, rest at predicted fib levels? Yes, and that is where Fibonacci pinball comes into play. So let's go ahead and shift gears then and take a look at that next. All right, so we have, and I recently put this together, this educational module on our site that is kind of interactive and goes through Fibonacci pinball, hopefully explaining it fairly well. So once we basically have an idea that a corrective pullback has completed, we have a nice ABC down that's counter trend, and we believe that a bottom is in place. For example, if we have a trend to the upside and price should be turning up in the start of the next motive wave to continue that trend at one higher degree, what we look for is an initial 5 waves up from the low, and this will be wave 1 of our motive structure. So as you can see here, we have a bottom that we believe has completed a corrective ABC at one higher degree, and then 5 waves up off of that low as what should be wave 1 of our next 5-wave move to the upside. So next, after we have that initial 5 waves up as wave 1, then we're looking for that to be followed by the corrective wave 2 pullback. And usually a wave 2 pullback following 5 waves up as wave 1 is going to retrace a standard 38.2 to 61.8% of that price movement that was made by wave 1. So you should have retracement fibs in your charting software. You just measure from the bottom of wave 1 to the top of wave 1, and that'll give you your retracement fibs, and you look for a nice 3-wave pullback into a 382, a 50%, or a 618 retrace are the most common targets reached by wave 2. So to apply Fibonacci pinball, the first reference point that we need is the low from which wave 1 starts, so the bottom of that C wave where the correction completed and price turned back up in the start of that wave 1. So that low point, that swing low. The next reference point we're going to need is the high where that wave 1 completed. So after the 5 waves up off the low finishes and we turn back down on the corrective wave 2, that is our second reference point. So we're basically taking the swing low, the swing high, measuring the distance traveled by price, not duration, just price, or not time, just price, during that wave 1. And we need that measurement to calculate our Fibonacci extensions. So the distance between this 0% extension and this 100% extension fib is going to be that same distance traveled by wave 1. And then we're going to use the bottom of wave 2, that's our final or third reference point, and project that measurement from where wave 2 completed. So this same 100% extension is still that same distance traveled by wave 1. So if you have Fibonacci expansion tool or extension tool in your charting software, those are the 3 reference points you use to measure those fibs. You're going to click on the bottom of the C wave where the wave 1 started, then you're going to click at the top of wave 1 next to measure that distance, and then click on the bottom of wave 2 to project those fibs off of that wave 2 low. So that gives us basically the targets going higher that the rest of the impulsive structure should kind of play pinball, quote unquote, as it unfolds between those fibs. So what we initially look for as we begin to start wave 3 of an impulse is price to target the 382 extension. If we see a micro 5 waves up off of the low, reach the 382 extension to complete wave 1 of 3, again, fractal nature, all of these actionary waves themselves should be subdividing into smaller degree 5s. So if I were to look at this as an actual price chart, this should be little micro 5 waves. If we hit the 382 extension for wave 1 of 3, then that basically dictates our expectations for the rest of the structure going forward. What we're going to expect next is wave 2 to pull back to around the 236. The wave 2 pulling back, wave 2 of 3 pulling back to the 236 isn't exact. You can just as easily use a small retracement of that wave 1, look for the same standard 382 to 618 retrace that you normally see for wave 2. That's pretty much just as effective. But once you have that initial 1 and 2 start to your wave 3, and wave 1 of 3 hit the 382 extension, then you're going to expect wave 3 of 3 to hit that 100% extension. So if you're developing a trade plan based on this, you're trading to the upside, you think you have a nice 1-2 start to an impulse, you are going to start layering into your position on the wave 2 pullback, or just kind of waiting for confirmation that wave 2 has completed to enter your position, depending on how you want to approach that trade. Typically, at least my approach, and you can obviously design your own trade differently than this, but I like to take an initial tranche of my position off at the wave 3 of 3 target. So let's say I had 3 different tranches that I was adding to the position as it pulled back in wave 2. Let's say maybe I put 1 order entry at the 382 retrace, 1 at the 50%, 1 at the 618. They all got filled. I would take the first tranche off, take profits at the wave 3 of 3 target. And our expected target is that 100% extension fib based on wave 1 of 3 hitting the 382 extension. So after wave 3 of 3 reaches the 100% extension, then we want to see wave 4 of 3 pull back into the 764 to the 618 extension, and it should hold that 618 extension. I don't have an exact percentage that I've calculated based on actual data, but I would estimate that 80% of the time, if you're dealing with what you believe is an impulsive structure, 1-2 start to an impulse, wave 3 of 3 hits the 100% extension, and you start pulling back in what you believe is wave 4 of 3, and it breaks that 618, 80% of the time that impulse is going to fail. It's going to continue down, it's not going to hold, and turn back up in wave 5 of 3 next, and this was actually a corrective ABC 3-wave move to the upside as part of the larger correction still. So very important usually that the 618 extension is going to hold for that wave 4. So if you want to set a stop on your position just underneath that, the majority of the time, if you're correct in that impulse, your stop will not get hit. You will maintain the trade while still protecting some profits in case it does invalidate. So again, it should hold after hitting a 100% extension, a 618 extension on the wave 4. And then assuming that 618 does hold, your next target is going to be the 1382 extension for the wave 5 of 3. And that should complete the larger degree, 1 higher degree, 3rd wave, the same degree as this one too. So we filled out 5 waves basically for that 3rd. Again, fractal nature, they should subdivide into 5 waves, each actionary wave themselves. So assuming our 3rd wave topped at the 1382 extension, what we're going to expect next is a corrective 3-wave pullback. That should hold between the 100 and the 764 next as our 4th wave. So once we believe that 4th wave has filled out into the target support and it holds the 100 or 764 extension, then we're looking for wave 5 of the impulse to target the 1764. So we should fill out 5 waves up into that fib target. And then so again, sorry, I kind of got ahead of myself here, but for the trading plan, and I, let's say again, had 3 tranches for my position, I took 1 tranche off at the wave 3 of 3 target. Whether or not you want to add that back at the wave 4 of 3 target, again, really depends on how you're approaching that personal trade, how much confidence you have, etc. Number of different parameters can dictate whether or not you want to add back that tranche or just wait for the next move higher. But the next spot to be taking profits, let's say take my 2nd tranche off, or 2 of the tranches, if I add it back on that wave 4 of 3, would be at our wave 5 of 3 target. And then we'll wait to see if the 4th wave pulls back as expected. and hold support where it should, in between that 764 and the 100% extension, and then you can add those tranches back, and then take profits again at the 1764 extension. And then also at that point, and it's pretty much on this example, right around that same 618 extension, but you can move your stop up just underneath the top of that wave 1 high, since when we're dealing with an impulsive structure, you expect no overlap from wave 4 into that wave 1 price territory. So setting your stop just underneath where that wave 1 completed will ensure that you take no losses on the trade, assuming you got nice fills in the wave 2 pullback, and you're not going to basically be caught flat-footed if it fails to hold, for example, this fourth wave. And this was just another corrective 3-wave move to the upside. So we can use these fibs to basically come up with, 1, targets for a trade, which is very important, especially if you are trading using options, you need a strike price. And then 2, where our stops should go. Where we should be placing our stops to make sure that 1, we're protecting profits, and 2, it doesn't turn into a losing trade. So we can use these fibs on expectations based off of them to move our stops, place our targets, where we take profits, etc., and basically helps develop that trading plan with pretty darn good accuracy. So this is only one of the common scenarios. I think we can go through this next one a little bit quicker since you guys kind of got the idea there. Let's reverse back to that initial one to start off the low. And what if that initial 5 waves up as wave 1 of 3, rather than stopping at the 382 extension, moves all the way to the 618? So those are the 2 common targets that you'll see for wave 1 of 3. Either stopping at the 382 extension or pushing a little bit further to the 618 extension. So if your wave 1 of 3 targets the 618 extension, that changes the rest of the targets a little bit going forward. And these are the 2 most common kind of standard Fibonacci pinball scenarios that you're going to see. The majority of impulsive structures obey these fibs. We will go at the very end over what happens when it extends beyond that. But after hitting the 618 extension for wave 1 of 3, then coming back to the 382 to the 236 for wave 2 of 3, should hold. Obviously, we can't fall back below the wave 2 low, or that invalidates the 1-2 start. But if your wave 1 of 3 hits the 618 extension, then rather than looking for the 100% extension for wave 3 of 3, instead you're going to be looking at the 1-2-3-6. So that just changes your target slightly, where you may be taking initial profits, etc., and then pulling back between the 100 to the 764. You can still, in this situation, set your stop at around the 618, or even just underneath this wave 1 high, since again we should not see overlap in the structure if it's a standard impulse. But looking at the 100 to 764 as your target support for the 4th wave pullback, wave 4 of 3, assuming that holds, rather than targeting the 1382 extension for wave 5 of 3, you're going to look for the 1618. And that would be your next point to take some profits. Assuming wave 3 completes there, and you start to pull back in wave 4, then between the 100% to the 764 is where you look for the target support as that 4th wave to hold, with the 100% being slightly more common than seeing deeper down to the 764. So that would be your basically where you might put a limit order to enter back into the position. And assuming your 4th wave holds that 100% extension, then looking for wave 5 to target the 200%. So those are the 2 most common scenarios, again, that you'll see more often than not when you're dealing with standard impulse, as far as where those subdivisions of the impulse will be kind of playing pinball between based on those fib extensions. But obviously we know that every chart is not the same. It's not always going to play out to theoretical perfection in the market, in the actual market. So what happens when one of those subwaves extends beyond your standard expectation? Basically, it's pretty simple. All you're going to do is adjust the price targets for the subsequent subwaves by the same relative amount. So we have the same 1-2 start off of our low of a completed correction. Let's say it initially is playing out towards standard expectations for Fibonacci pinball. We measured our fibs. The initial wave 1 hits the 618. We pull back in the wave 2 of 3, and then price begins to start wave 3 of 3. So we're looking for that 1, 2, 3, 6 extension. Maybe we even place the limit order there to sell our position. And let's say we got filled, but price doesn't stop there. It doesn't turn back down from there, and the wave 4 of 3 just keeps going and reaches all the way to the 1618 extension instead. And we're saying to ourselves, well, shoot, I got out too early. What do I do? Do I chase here, or do I be patient, wait for the next pullback? Where is the next pullback in the target now that it's extended beyond that normal 1, 2, 3, 6 extension? Again, what we're going to do is adjust the rest of our targets that same relative amount. So wave 3, the normal target would have been that 1, 2, 3, 6 extension. Instead, it reached 2 fibs higher. So we're going to adjust the support target for wave 4 of 3 by the same relative amount. So rather than the 100 to 764, we're going to move that up 2 fibs. So 1, 2. That will be the 1382 to the 1236 instead. So sorry, it's going a little bit slow. So yeah, we move our target up 2 fibs. That's where we're now going to expect that wave 4 to target. Another tool that you can use is a very, very common target for a fourth wave is the 382 retrace, the 38.2% retrace of the wave 3 at the same degree. So this move from this wave 2 low to this wave 3 high, 382 retrace of that move is the standard fourth wave target support. And usually that's going to line up with the same fibs you're watching based on that higher degree 1, 2. So assuming we hold support there for the wave 4 of 3, our expectations for wave 5 of 3 are going to be basically adjusted using the same method. Normal target would have been a 1618 extension. We're going to move that up 2 fibs to the 200% as our target for the wave 5 of 3. So let's say we put our limit order there, moving it up 2 fibs for the wave 4 of 3, got filled, and that's now our target for the wave 5 of 3, moving 2 fibs up as well. Pretty much straightforward for the rest of the subwaves, 2 fibs up for the wave 4 support rather than the 100% extension, move it up 2 fibs to the 1382. Rather than the 200% extension as our target for wave 5, move that up 2 fibs to the 2382. All right, so that, again, brief introduction to Fibonacci pinball. Obviously, it's going to take a little bit of practice and going over some charts and applying it by yourself to get a good handle of it. But once you do, you'll find how powerful of a tool it can be. One, not to just navigate markets, but two, to develop a trading plan around. One of the hardest things sometimes is knowing when to get out of a trade, when to take profits, or when to stay in that trade, trying to ride that trend as far as possible to be the most profitable you can with that trade. And Fibonacci pinball can really assist you pretty substantially in achieving that. We won't go over the diagonals, but you can also, if you are familiar with diagonal structures in Elliott wave theory, you can apply them in pretty similar manner, Fibonacci pinball, to those. All right, but let's get away from theoretical stuff and let's take a look at some actual charts here. That's what we're all here for, right? So can you guys see? I have a chart of the CNX Nifty on my screen right now. Yes, okay, hold on. Let me take a look at any questions that got snuck in while we were looking at that Fibonacci pinball. Essentially, broader waves 1 and 3 are made up of minor 5 waves. Should there be more or less than 5 waves, would it invalidate the pattern? So sometimes you'll see situations where it looks like 9 waves or something within that wave 3, but really what you're looking at is probably the subwaves of one of the smaller degree waves. I don't have a great example in front of me right now, but if it looks like more than 5 waves, again, it's probably just extensions within one of those subwaves where those subwaves within that subwave look like they're part of the larger degree trend. But follow those fibs. That's what's really going to help you navigate when that wave 3 actually completes, when the 4th wave pullback happens, and when the 5th wave from there unfolds. So if it's following Fibonacci pinball, it has the same technical readings that you normally expect with an impulsive structure. That's, wave 3 should have the strongest technicals, wave 3 of 3 to be exact. You should start seeing divergence as it fills out wave 5 of 3, and then even more divergence on the 5th wave. Everything's kind of matching, Fibonacci pinball fibs, technicals, etc. Despite how messy those subwaves may look, that gives you a much better idea of when that actual impulse is completing and the next change in trend is likely to happen. So this is one of my favorite examples to use when showing people or introducing people to Fibonacci pinball because of how textbook it is. So this is back in 2013 for the Nifty. We had a nice, remember, 3-wave pullback, ABC into a low, and then price reversed from that low in what can be a little micro 1, 2, 3, 4, and 5 waves to the upside. So we're assuming our corrective pullback has finished, and this is wave 1 of our next impulse to the upside. 1. And then we saw our pullback here is wave 2. Again, normally for wave 2 pullback, you're just going to throw some retracement fibs on there. Look for a standard 382 to 618 pullback of the measurement of that wave 1. In this case, it kind of bottomed in between 15 to 618. So let's say you put limit orders to enter that trade. One at the 382, one at the 50%, one at the 618. So in that case, you would have been filled on 2 out of the 3 tranches. If you still felt underexposed, could then add that next tranche back in later in the pattern. Or if you wanted to wait for a breakout or something, confirmation that the wave 3 was starting, then maybe you buy that breakout as your last entry. So we filled out the 1 and 2 start off of our low. Again, we think this is an impulse developing to the upside, so we're going to put on our fibs here. Again, our first reference point for the fib expansion tool is going to be the bottom of wave 1, where that wave 1 started. Next reference point is going to be the high where wave 1 completed, and then our third reference point, the low where wave 2 completed. So that gives us our extension fibs going forward, and if we were watching this unfold in real time, the initial move up here, although there's a gap here, we did see price come straight up to and I know we can see the price structure ahead of time, so it makes it a little less exciting, but I'm just going to put the labels on there just so it's easier to follow along with what I'm talking about. So we see that initial move up, and again, there's a gap, so the subwaves aren't really that clear in there because of that gap, but we see it come right into a 618 extension and then begin to consolidate from there. So that looks pretty good as our wave 1, and then the consolidation as our wave 2 of 3. And so again, based on wave 1 of 3 hitting that 618 extension, what are we going to expect for wave 3 of 3? We're going to expect it to come up to the 1, 2, 3, 6 extension. So that would be, again, a potential point to take profit on the trade if you're interested in doing so there, or waiting for the full third wave itself to fill out if you're trying to catch a little bit more of that move. So then we pull back to the 100% extension again. After hitting the 1, 2, 3, 6, we should come back to the 100, between the 100 and the 764. In this case, it held a little bit higher at that 100% extension fib. And then based on wave 3 of 3 hitting the 1, 2, 3, 6, we're going to expect wave 5 of 3 to target that 1, 6, 1, 8 extension. So we got a nice move up to there, slight overshoot of that resistance fib, but then a turn back down as expected in what should be the 4th wave. So that 4th wave again should find support between the 100% and the 764. So we got a nice move down here, maybe perhaps for the sake of alternation. If you guys are familiar with alternation as one of the guidelines within Elliott wave theory, usually it's at the same degree, but you will see at different degrees sometimes that alternation. But we saw a shallower 4th wave in the wave 5 of 3, so seeing a little bit deeper in that higher degree 4th kind of makes some sense there. But it does hold that overall support region for fourth wave. There's no overlap back into the wave one price territory, basically continuing to cooperate according to expectations based on Elliott wave theory and Fibonacci pinball. And then what we're going to look for, again, based on our wave 3 hitting that 1618 extension, wave 5 then targeting the 200% extension. So we see a nice move up as that fifth wave into that 200% extension. But one of the reasons why I think this is a great example of Fibonacci pinball is because of that fractal nature. And you can actually see here another perfect impulse as the fifth wave. Again, these actionary waves themselves should be breaking down into 5 waves. You can see another perfect looking impulse for that fifth. You guys can recognize that there. Nice wave 1, 2, 3, 4, and then 5, filling that out. But what's even better is we can apply that same Fibonacci pinball at the smaller degree there. And you'll see it obeys Fibonacci pinball for that fifth wave as well. So you have your initial wave 1 of 3 come into that 618 extension. Pull back as the wave 2 of 3. You have your wave 3 of 3, target of 1, 2, 3, 6. It's a little bit crowded here, so you can't actually see that, but now you can see that 1, 2, 3, 6 extension. Wave 3 of 3 targets that, pulls back in between the 100 and 764 is wave 5 of 3. You'll notice that the fifth wave of our 3 comes a little bit shy of our 1618 extension target. However, when that happens, when you see a third wave come a little bit shy of the expected target, and especially if your wave 2 at the same degree was a quick zigzag, more often than not, you're going to see an expanded flat fill out, so that the B wave of that fourth ends up coming up, making a higher high, hitting that fib target, and then filling out the C of 4. So then we come back to the 100% extension for our fourth, and then head up to the 200% extension, which aligns with our higher degree 200% extension for that final fifth of fifth. So I think a really nice example of Fibonacci pinball there in the Nifty chart, but I don't really want to sit here and cherry pick charts for you guys. I thought it would be kind of fun if you guys gave me some examples that we could maybe look at of charts that you think may fit those criteria we discussed at the beginning, a nice trending chart. Maybe it's been consolidating and what looks like a corrective move recently, and you think the trend is going to continue. Any symbols coming to mind you guys want to take a look at? Hold on a quick couple of questions here before we do that. Can we please talk about divergence a little bit? So what I use technicals for is looking for divergence, and divergence is basically when you see a deviation between what price is doing and what those technical indicators are doing. So you'll see here an example of negative divergence, where price is continuing to make higher highs, whereas our technicals here are not. They're making lower highs on each subsequent move. So that is what is referred to as negative divergence. As you can see, lower highs on the MACD, higher highs from price. And again, you're going to see that in an impulsive structure. You should see your strongest technical readings during the wave 3 of 3. And then usually you'll see divergence begin to develop from there as you fill out wave 5 of 3. Typically, you're going to see some divergence between the wave 3 of 3 high, and then even more divergence on the overall fifth wave. And even within that fifth, you can see that same divergence. Strongest technical point of this move from where the wave 5 started to where it completed is on the wave 3 of 3 within that fifth. Another thing you look for is positive divergence on corrective pullbacks. And again, I'm talking right now about trends to the upside. Obviously, the reverse is the case when you're looking to the downside in a trending move. But you usually want to see positive divergence on the C wave in relation to the A wave. It's not always going to be the case, but it's usually nice to see. It just helps, signal that you're not dealing with a third wave, you're dealing with a C wave, because again, a third should have the strongest technicals. So when you see a divergence between an A wave and a C wave, that's just further confirmation that you're dealing with a corrective structure and not an impulse. Richard, my favorite oscillators, I'm pretty simple. I use the MACD and the RSI. You can see there's fainter lines behind here. On the MACD, behind the MACD is the price percentage oscillator. That's just, I think, more useful than the MACD on very large time frames when you're dealing with very big percentage moves, because that takes that into account. And then the RSI behind that, you can see stochastics. And I kind of use that for, rather than divergence, more looking at embedded status. When the stochastics is above 70, I consider it embedded to the upside until it crosses back below 70. Very strong portion of the move when it's embedded to the upside. Usually not a time to look for a trend change until it comes back below the 70 level. And the same can be said for embedded to the downside when it crosses below the 30 level and then back through the 30 level. Next question, if the pattern fails, what is more probable, that it tries to reform the same pattern or return sideways first and then after a couple of days into a new pattern? So usually, if, let's say, this impulsive structure failed, let's say we started off with what we believed was a new impulse to the upside after completing this corrective ABC. Let's say it fell down to the wave 3, but then this fourth didn't hold support, and it just kept dropping and broke into the wave 1 price territory to invalidate a standard impulse. Well, then we would be left with 3 waves to the upside, and then we'd have to, at that point, ask ourselves, is that an ABC up as part of a larger correction? So maybe this was only a larger A wave down, this is a larger B wave, and that's going to fill out as a C wave for an even bigger corrective ABC. Maybe it's an ABC up as wave 1 of what will be a diagonal instead. I didn't go over diagonals, but if you're familiar with those, the actionary waves of diagonals will unfold as 3 waves. So your wave 1 will be an ABC, pull back on the wave 2 will be an ABC, then your wave 3 will also be an ABC. A little bit more complex, less desirable to trade because of that reason. We always strive for looking for standard impulses because they're 1, the least variable, 2, the strongest trending moves, and 3, cooperate with Fibonacci pinball the best. So. And you're basically going to be making those decisions. Hopefully you have a larger degree count that you're basing expectations on. So you go back to whatever major low was made in a lot of charts. That's going to be the 2008, 2009 low. The vast majority of stocks are in an impulsive move, a large degree impulse up from that 2008, 2009 low. Let's go ahead and take a look at some of those charts that you guys just suggested, and we can kind of illustrate that. So one of them was Google. Let's take a look at that. Google, I think, is a great example. 1 of Fibonacci pinball, 2 of impulsive structure. So again, you usually try to, it's not necessary, but it will help your accuracy if you can come up with a good, reliable, longer-term count that you can then base expectations at the smaller degrees based on. Because remember, these patterns are all fractal in nature, so you're expecting a wave 3 to unfold as 5 waves, the wave 3 of that 3 to unfold as 5 waves, the wave 3 of that 3 to unfold as 5 waves, etc., at varying different degrees of price and time. So on Google here, going all the way back to its IPO date of 2004, it was one of those charts that basically had it straight up after it IPO'd. So that is the starting point of our count. That is our major low, our all-time low on this chart. And we can see what looks like a 5-wave move off of that IPO price, followed by a 3-wave pullback. So 5 waves up into the 2007 high here, and then a 3-wave pullback into the 2008 low. So I am counting that as wave 1 and 2 of an impulse at cycle degree, this 1 and 2 here. So then I took fibs, measuring again from the bottom of that wave 1 to the top of that wave 1, projecting that measurement from the bottom of wave 2. That gives me these gray fibs. Excuse me if they're a little bit difficult to see. You can kind of actually see them over here, but gives us those fibs going higher that we can then basically use to project how price is going to unfold in that cycle degree third wave based on Fibonacci pinball. So what are we looking for initially for our wave 1 of 3? We're looking for 5 waves up to fill out into our standard 382 to 618 extension here. If you, again, apologies if it's difficult to see, but this is the 382 right here, and this is the 618 extension. So we see 5 waves fill out into, in this case, close to a 50% extension. You'll see there will be some examples where 5 waves up will fill out into a 50% right in between that 618 and that 382. And then it kind of, I would say it's about equal as far as where your expected target for the wave 3 of 3 is, and whether it's going to be the 100 or the 1236, kind of because it's in between those two fibs. Normally I would look for a 100% extension, but let's say based on the smaller degree subwaves, it's starting to point a little bit higher than that, targeting the 1236 extension, then obviously that would be reason to adjust those expectations and move it up a little bit. So we filled out a wave 2 here, a little bit awkward because it's a running flat wave 2, where the actual low was not the low that's being counted as wave 2 in the count. It's just slightly higher here. And then we're looking for Fibonacci pinball at the smaller degree to then play out from there. So that's where these gold fibs come from. Measuring the bottom of that primary degree wave 1 to the top of primary degree wave 1, projected from the bottom of primary degree wave 2. As you can see then, this wave 1 of the smaller degree primary third here fills out into the 382 extension. That would give us a target of a 100% extension for the wave 3 of 3. But as price filled out into that target, it did look like only the top of wave 3 of 3 at that point. So it's one of those situations where you would then, based on these smaller degree structures, say, okay, well, maybe we're actually going to target 1 fib higher here. We're going to see an extension, and it's going to come up to the 1236 instead, which, as you can see, we got an almost exact tag at the 2015 high as what should be that intermediate degree, so 1 lesser degree than our primary, wave 3 of 3. Consolidation from there is wave 4 of 3. And then our expectation after that is for you typically wave 5 of 3 to then target the 1618. So again, I apologize for it being a little bit difficult to see. I got quite a few different fibs on here at the various different degrees, all kind of on top of each other. Let's move these over just a little bit here. So that, let's see, that 1618 here was back at 1135. However, do keep in mind the fib degree 1 higher than that, those gray fibs, when we got a 50% extension tag at our primary degree, and we should look for 100 to 1236 for the primary degree third wave. So our 100 was all the way back down here at 965. We've already exceeded that, and obviously the price pattern did not look complete into that fib. So that puts the next, that larger degree 1236 extension fib, up at 1567. I know that's a little bit higher based on the fibs at 1 lesser degree. That's actually near a 200% for those gold fibs. And as you can see, price is making an extension at that smaller degree, seemingly in order to stretch higher and reach that higher degree, that larger 200% extension fib. And the 1236 extension fib in gray. So that's up, roughly at the 1600 level. So that looks like a nice confluence of fibs that price potentially can be heading up and targeting. So again, we had our nice 1236 extension tag at the 2015 high for wave 3 of 3. A corrective pullback as the wave 4 of 3. It was relatively shallow in this case. It's, again, always not going to play out to theoretical perfection. You're going to see some shallow fourth waves, some shallow wave 2s. But from there, we got a nice impulsive 5 waves up in what looked very convincing, especially when it made a higher high. Wave 1 of the next 5th wave higher, our intermediate degree 5th. So after our 4th wave bottomed, looking for the intermediate degree 5th wave to play out, we can then place these red fibs on there. Did I move these over? Pull these, pull those over a little bit. To then project the move going forward from there, we initially saw a leading diagonal 5 waves fill out into roughly 618 extension, pulled back in wave 2 of 3, and then we saw the next 5 waves up fill out into 1382 extension. So that was our first clue that we were seeing this start to unfold as more of an extended third wave rather than those standard targets that we typically expect when we're dealing with the first one to start to an impulse and what we're normally looking for. So when wave 3 of 3 hit that 1382, then we pulled back to 100% in the wave 4 of 3. And then we would normally be looking at a 1764 based on extending 1 fib higher. Instead of that 1618, we would look at the 1 fib higher, the 1764 is our target for the next 5th wave. Price once again extended beyond that for that wave 5 of 3. So that same situation is going to adjust the targets for the rest of our fibs going forward. We saw a 4th wave pullback from there. So at this point, we're 2.5 fibs above, close to 3 fibs above the standard target for a 3rd wave. Again, standard target being 1618, so we're moving 1, 2, and it just stretched a little bit beyond that. For our wave 3, that means rather than the standard 764 to 100% extension target for our 4th, we're going to move 2 fibs up, 1, 2. And that is where our 4th wave came back, held support, and has since turned back up. And what should be the final 5th wave at minor degree, of the 5th wave at intermediate degree, of the 3rd wave at primary degree. Again, slightly confusing, but try to keep that kind of fractal nature of these various different degrees of patterns in mind when I'm going through these charts. So we're expecting, again, based on 3 fibs higher, normal target for that 5th would have been a 200% extension. 1, 2, 3 puts us at a 2618. We do have a gold fib there, so I like to see confluence between the various different degrees of fibs lining up to increase the probability of price reaching and putting in a turn at that target. So we do have 1 fib here at a higher degree at 1300 around that projected target. Certainly would be the kind of minimum expected upside that I'd be looking for. But again, as I was discussing when we first started looking at the chart, we have that higher degree 1236 extension up here, which would be great to reach for this wave 3 of 3 at primary degree before that top is put in place. So I think there's a very reasonable chance that price may continue to extend up towards 1600, get closer to that larger degree confluence of fibs before we complete this primary degree 3rd wave and see a pretty substantial correction in that primary degree 4th. So I think we could continue to unfold to the upside, fill out closer to that 1600 target for the primary degree 3rd wave, as long as we continue to hold support and don't invalidate any of the patterns at the smaller degree. So that pretty much at this point depends on price holding above the June low. As long as we're above there, we can easily continue to view this as extending further to the upside. And it seems unfortunate for smaller degree trading purposes, but not all that consequential if you're doing it as a swing trade. Seems to be unfolding as more of a ending diagonal structure. And again, I didn't go over those patterns in the interest of time, but basically the subwaves unfolding as an ABC. So you can see the same 1, 2, 3, 4, and 5, but the subwaves within those actionary waves, an A, B, and C, A currently working on the B, and then set up for wave C to fill out from there. And then, assuming we hold support again for that 4th wave, after that 3rd completes, then looking for the 5th to fill out. So again, you can kind of use at these various different degrees where those fibs are lining up based on Fibonacci pinball to kind of come up with a high probability target to look for. Apple, take a look at Apple. It's another decent one. We are a little bit over the hourly mark. Again, it's being recorded if you guys need to take off. I'm happy to keep going, take a look at a couple of charts though, and of course it'll be recorded if you want to come back to it later. So Apple, let's zoom out on this one as well. Take a look at the higher degree chart here. So we have, again, we're looking for a major low to kind of develop that large degree count that we can then place the smaller degree price action and context with to really come up with the most accurate expectations based on Elliott wave theory and Fibonacci pinball. So what we have here off of the all-time low, unlike Google, it didn't immediately head higher following the IPO. We did see an initial dip down into this 1982 low. That was the all-time low in Apple. And then from there, price filled out a leading diagonal wave one. So 5 waves up, but overlapping as a leading diagonal into this 1991 high. Then we saw a corrective ABC pullback into what looks like either 764 or 618 retrace, just underneath the 618. So I mean, somebody who's investing in these stocks and was really looking much longer term, that would have been obviously in hindsight, but a tremendous entry to then buy and hold that stock for several years going forward. Pulled back in that cycle degree wave 2 for the bottom in 1997, and then started to head to new highs from there. So we threw on some fibs to that chart. As you can see, these purple fibs are the ones at cycle degree. So in this case, we saw our initial wave 1 of 3 extend beyond normal expectations for wave 1 of 3. Normally, again, 382 to 618 is what we typically expect. In this case, we came even close to a 100% extension. So that would be 2 fibs higher, 1, 2, than that standard 618, which means our expectation for wave 3 of 3 would be 2 fibs higher as well. So normal expectation, 1, 2, 3, 6 extension for a wave 2 of 3. We're going to move 2 fibs higher, 1, 2. That is where our wave 3 of 3 ended up completing. We saw a very deep, drawn-out, lengthy wave 2 at primary degree back into the 2003 low. For the sake of alternation, a much shorter-lived, shallower fourth wave that played pinball well, though. It pulled back a nice 2 fibs there. Normally, again, between the 764 and 100% extension, but we're moving up fibs by 2, 1, 2, up to that 1, 2, 3, 6. Nice fourth wave back into that support, and then turned up in the fifth. So again, based on wave 3 of 3 hitting the 2 fibs higher, we're going to expect the same from our fifth wave initially. So instead of this 1618, that would be 1, 2. That was back at 80 though. This is after price adjustments. We've obviously continued to extend beyond that, which means we're seeing another extension in the pattern here, and is now reaching towards the, let's see, can't really see the fibs. Try to pull them up, put them on top here. We're now reaching towards a 2382 extension is kind of where price is close to reaching right now. But it still looks, I mean, if we examine the price structure at the smaller degrees, we didn't see any cycle degree fourth wave pullback correction yet. So this is still an extension within that cycle degree third. The cycle degree fourth is still going to be coming once we finally put in a top to the cycle degree third wave. So let's zoom back in, take a look at that. Back at the bottom of our wave 4 here was the 2009 low. As I mentioned, the vast majority of stocks are in impulsive counts off of that 2009 low. If they don't have a lot of previous history, that may be the starting point of the count. If they do have previous history, that may be the bottom of a larger degree wave 2 or fourth wave. It really depends on the individual chart. But we got 5 waves up from that low. Very shallow, short-lived wave 2 in this case. Very high-level consolidation. Pretty abnormal, but again, in financial markets, it's not always going to play out to theoretical perfection every time. But we can still apply Fibonacci pinball in the same manner. 5 waves up is that intermediate degree wave 1. Then we pulled back in the wave 2. So we're placing our fibs based on that wave 1 measurement projected from the bottom of wave 2. That's where these gold fibs come from. 382 extension reach for wave 1 of 3. But then we did see an extension in wave 3 of 3. It reached closer to a 1382 extension. So that, in this case, would normally make us move up our targets, but we actually did then just stop at a standard 1618 for the wave 5 of 3 here. It just happened to be an extended third wave, and then to compensate, a muted fifth wave to that standard 1618. Pulled back from there to 1236, and is from that support filling out what should be that intermediate degree fifth wave of the primary degree fifth of that cycle third. I'll zoom into that one. Another leading diagonal. Apple does like leading diagonal wave ones based on prior history. Leading diagonal wave 1, 2, another extended third wave here, only slightly extended. You saw our wave 3 of 3 rather than stopping at a 1236. It reached 1 fib higher. And then the wave 5 of 3, rather than stopping at the 1618, just reached 1 fib higher there. Pulled back into standard support for a fourth wave, seemed to have another one to start into the next fifth wave higher. That seems to be unfolding as an ending diagonal on this chart as well. A lot of the technology stocks, since the lows that we saw in February of this year, seem to be filling out ending diagonal fifth waves. We're coming into, based on Fibonacci pinball again, 1382, 1618 extension, fairly standard target for a third wave. It's got room for a little bit higher here to finish that third, expected to pull back into fourth, and then from there fill out the fifth wave. So applying a trading plan to these charts, again, you have to figure out what time frame you're interested in trading. Are you trading this entire move at the minor degree? Are you trading just a wave 3 of 3? Are you trading a wave 5 of 3? Are you trading a wave 5 of 5? Are you going to scalp this last? Well, I wouldn't really call it a scalp because it's still going to be several weeks, if not months, but that final fifth of the fifth, these sorts of things you have to decide beforehand when you're developing that plan for trading it. But you can see how powerful Fibonacci pinball can be in helping you navigate that structure and identifying, one, where you are in that larger pattern based on those fibs, based on the price structure, based on technicals, etc. And two, where is a good spot to start to either tighten up stops or reduce position size or take profits entirely and look for a corrective pullback to either get back in or, maybe you're expecting it to be, for example, this very significant cycle degree top. So it would be one of those situations where if I was a long-term investor who had bought all the way back here, I was applying Elliott wave theory at the time, I saw this big leading diagonal cycle degree wave 1 and pull back as a cycle degree wave 2. I said, I'm going to buy and hold this company until I feel like the majority of the cycle degree third wave has filled out. We're getting to that point decades later where it seems like, well, yeah, we're pretty full in the count here. It seems like price is getting pretty close to approaching that cycle degree third wave top. This is not really the best risk reward to be maintaining this position. Maybe I'll maintain it, put in a trailing stop that I feel comfortable with, and when I get stopped out, that'll be that. But certainly a point in the pattern where I would be thinking about reducing some risk. All you guys just recommended tech stocks. You guys don't want to look at anything else but tech stocks. Those are the only recommendations we got. We can do Tencent. In fairness, a lot of them have really nice Fibonacci patterns, pinball patterns, and Elliott wave patterns filling out. So they're pretty attractive to trade for that reason because it makes them easier to navigate. Tencent, all-time low here back in 2008, so that's where we have to start our count. We had what looks like an impulsive move up to that 2011 high. Pull back from there, fairly shallow, but I think it was roughly 382, actually not even quite a 382. It was a strong portion of the market, though. So that is our primary degree, in this case, 1, 2. So we're measuring our fibs based on the size of that primary degree wave 1, projecting it from the bottom of primary degree wave 2, and then based on those fibs, hopefully navigating the rest of our impulsive structure going forward. So we saw our wave 1 of 3 target the 382 extension. That places our wave 3 of 3 target at the 100% extension. We did slightly exceed that for the wave 3 of 3 before pulling back in wave 4 of 3. But based on that slight extension, that gives us reason to maybe look for the 1618 wave 5 of 3, especially when this looked like it wasn't quite complete with subdivisions within that 5th wave as we were starting to approach it. So this looks like another 1, 2, 3, 4, and assuming we can hold support here for that 4th, ideally setting up one more final high in this wave 5 of 5 before the primary 3rd completes, then we start that next higher degree correction as a 4th wave, which if we're going to stop at a 1764, we're going to place our expected target 1 fib higher than the 100% at this 1236. So let's zoom back in quickly for that. As you can see recently, I think they just reported earnings. Was it today or yesterday? Anyway, entering into standard expected targets, let's throw the fibs on there just so you can see it a little bit better. These aren't quite connected to the highs and lows here. But we have a wave 3. Subdivisions aren't exactly the clearest. It was kind of just a straight line, but it topped out in between our standard 1382 to 1618. So I'm gonna look for a standard 100 to 764 as the support target for a 4th wave. That's where we are at right now. The question is, are we gonna hold? It's a situation where this might be an attractive setup for you to trade if you're looking to play that 5th wave higher. So this would be a point where you can look for entries. Either you're just buying with a stop in mind, risking that amount that your stop is placed at. Of course, I would put it no lower personally than just underneath the 618 extension here. Or you're waiting for, on the smaller degree, time frames, turn back up in what looks like a micro 5 waves up off the low, maybe, an indication of a trend change by making a higher high compared to the high that we saw so far in August before entering. Really depends on your approach and your risk appetite. And then looking for price. Normally you would look for higher than this 1618 extension, but because that's where we overlap with the higher degree fib, that's right now I'm being a little bit more conservative, looking for price to reach there and put in that top for that primary wave 3. It's entirely possible, assuming we hold support for this 4th, that we hit, based on the red fibs, a more standard 1764 to 200%. But because those don't really overlap with higher degree fibs, being a little bit more conservative, and I would certainly start to tighten up my stop, reduce risk, etc., as we approached that 65 level. All right, a couple more questions. Sergio asks, what is my average holding time? I'm personally more of a swing trader. I like to hold for several weeks, if not months. Some trades even longer than that. More because I'm an analyst. I don't have time based on my duties on Elliott Wave Trader and the site, answering questions, taking requests, etc., to really be glued to the screen or a chart screen looking at daily gyrations up and down and doing day trading. I'm much more comfortable, taking a longer term position based on bigger patterns, bigger structures, and in trading the weekly, monthly type swing trades. So I usually trade based off of a daily chart or a 60-minute is about as small time frame as I go when I'm looking at charting. Next question, what are the best waves to trade, 3 or 5? 3, obviously, if you have a nice 1-2 setup, a 3rd wave is the best because they're the strongest trending portion of the move. Any surprises are likely going to be to the sides of extensions rather than truncation, so you're more likely to see price exceed your expectations rather than come short of reaching them. And usually it's not where a trend change is going to be seen. You're going to see another corrective 4th wave pullback and then a 5th wave. So it's a little bit more forgiving. Let's say if you didn't quite reach your 3rd wave target, you didn't get out of the trade, you'd say, okay, well, I'm going to maintain my stop below where fourth wave support should be. I'm going to hold through the fourth, especially if it's, not very high time frame fourth, and I don't care about that capital being tied up at that time. And then I'll try to exit on the fifth wave. So more desirable to trade a third for those reasons, but we're unfortunately kind of at a point in the larger market patterns where the majority of third waves are behind us at this point. We're kind of left with fifth waves, the last little bits and pieces of meat left on the bone here as we start to approach a primary degree third wave top on the vast majority of charts. So we're looking at, once we finish this last little bit of upside, likely 20, I'm predicting closer to 30% correction in the market next. Not yet. I do think we have further upside to be seen. Fill out the fifth waves that we've kind of seen on a lot of these charts that I've looked at so far, but then put in a major top there and start to pull back into fourth wave. So you do have to keep that in mind, kind of maybe adjust your risk parameters slightly based on that, take slightly less risk, smaller position sizes, tighter stops, etc. Because we are approaching likely that larger degree top and setting up a pretty substantial correction that obviously you don't want to be holding as price fills out. And the next question, what indication would there be to determine whether price would continue or reverse after corrective wave C? So what you're looking for is, one, did that ABC pullback kind of fulfill expectations based on the proportions of the rest of the structure? So if you're looking at a wave 2 pullback, did the ABC pull back into a standard 382 to 618 retrace of the prior wave 1? Does it look proportional in size to that wave 1? These are the sorts of things that you'll get better at as you practice more and you look at more charts, watch more patterns unfold, and you'll kind of just get a feeling for price patterns and when they're looking like they're proportional and likely to be complete. Is there positive divergence on the C wave? Is that bottom that you think completed the C wave then followed by what looks like a nice impulsive turn back up in a micro 5 waves? There's a number of different things you look at to help gauge probabilities. Obviously, we're only dealing with probabilities when trading. There's no certainties. But when you're looking at those probabilities substantially increasing to the point where you think they're favorable enough to attempt to trade. BTI. Let's take a look at that one. British Tobacco. A non-tech chart. Let's zoom out on this one. We have a major low here back in 1983. And what looks like 5 waves up I have it as super cycle in this case, but 5 waves up as a super cycle degree. Wave 1, you have your 3 wave ABC pullback and what looks like a nice 50% retrace here, just above 50%. Then from there, you produced another 5 waves up into a 618 extension, which is what we typically expect for a wave 1 of 3. Pulled back pretty deep in this case, but held the prior low in a 3-wave pullback in the cycle degree wave 2. Then produced another 5 up as the primary degree wave 1 and 2. Based on those smaller degree fibs, as you can see here in gray, that was a 764 extension, so slightly beyond standard expectations. That means we can, assuming price continues to cooperate, look for a little bit higher to be reached in the wave 3 of 3. In this case, we actually extended pretty high beyond the 1, 2, 3, 6. So normally you'd probably look for 1, 3, 8, 2. We even got higher than that in this case, likely to head up and reach that higher degree purple fib. As I mentioned when we were looking at Google, you're going to notice that when there is a confluence of a lot of different degree fibs lining up all at the same spot, price is more likely to end up targeting where that confluence is, and maybe see extensions in the smaller time frames, or maybe not quite reach normal expected targets in order to put in that turn at where that confluence is. So you kind of have to make adjustments based on where those fibs are lining up for your expectations on where price might make those turns and fill out those subwaves into. So we had a wave 3 of 3 fill out into the higher degree 1236, but at that smaller degree fibs, I think it was 1618. Then we pulled back to 100% in the fourth wave, and since have come. We didn't quite make it in this case to the 1618. It was very close. It looked like a nice high probability target up at around 83. Didn't quite make it that high though, and it started to turn back down in a manner significant enough to suggest that we may have seen truncation. So in normal expectations, this fifth wave ideally would have stretched all the way up there to hit these fibs here. But with it breaking below the prior fourth wave low, with it breaking below one higher degree fourth wave low after that, it's looking like this completed the structure. And we can easily, despite that truncation, squeeze 5 waves up in this fifth wave off the 2009 low. So we can get a nice 1, 2, 3, 4. Let's throw some fibs on there, see how that played with Fibonacci pinball. You got a 1, 3, 8, 2. Extension on your wave 3 of 3, but then your wave 5 of 3 stopped at the standard 1618. Held a little bit higher in the fourth wave pullback there than the normal 100% extension target, but then proceeded to fill out. Again, came a little bit shy. We saw some truncation up there. I'm not sure if there was some news catalyst that did slightly affect the price there, but sometimes you will see that. Again, at the beginning of the webinar, I talked about how Elliott wave theory postulates that it's not external events that are driving price, but it's kind of one of those situations where it's, take for example the analogy of a trail of ants going along a path. If you were to drop a stick in front of those ants, there might be some initial chaos, confusion as they figure out what just happened, but eventually they'll find a way around that stick and continue on in the same path. You can, in a lot of cases, view what look like major disruptions from news events on charts in kind of the same somewhat manner. Candidate for a retching chart, MCK. Let's take a look at MCK. And then we're a little bit over time, so we'll conclude it after that. So this would be one of those situations where I would look at this chart and I would say, this doesn't qualify as a great chart to trade. It's not unfolding in an impulsive manner. There's not a clear impulsive structure to these moves. As you can see, it's making moves in 3 waves, not 5 waves. That suggests a larger diagonal structure. On top of that, the high that we've seen here and the pullback into this low in 2016 didn't produce 5 waves up. Looks like a 3-wave move. So there's nothing to indicate that this was a lasting bottom, a completed correction, and price is ready to potentially head to new highs based on the larger chart too. It seems like if we're unfolding as a diagonal where this is an ABC for each actionary wave, the fourth wave has plenty of room to dip deeper here. So this is one of those charts where I'm not bullish on, and I would expect price instead to actually continue to fill out deeper here as it completes wave C of this primary fourth. And then we'll see at that point if it looks like it's ready to turn back up and maybe head higher in that primary fifth, at which point then it might become still not the most desirable chart to trade, but at least a little bit better than it looks at the current state right now. So you want to see nice standard impulse moves that are cooperating with Fibonacci pinball, ideally at the higher degrees and that higher degree count that you have confidence in to really come up with the best chances of success in your trading. Richard comments, you have a lot of information on your website. I joined for free trial yesterday. Can you tell me how to go to the trading room? Yeah, let's take a look at that real quick. All right, so here's the site. And our homepage, if you've landed on this or you haven't signed in, sign in, and then that should take you to the trading room. And depending on what services you are subscribed to, if you'd elected to take a free trial on all the services, in the beginning here, you're going to notice that there, as you said, it's kind of like drinking from a fire hose. Some of our members have commented. We have a lot of different services to help accommodate all of our members who aren't all trading the same markets. We have a cryptocurrency service. We have volatility service based on Bayesian timing, another based on quant signals, smart money signals. We have stock waves, which I was advertising at the beginning of the webinar, which is one of the services that I'm a part of with Zach Manez. And we take a look at all of the US equity stocks. So any coverage of Apple or Google or the charts we were looking at today would be under that service. We have one that's focused strictly on mining stocks, and one that is option focused. So Gamma Optimizer looks at different option trades. Another service that I'm part of, World Markets, Forex. So World Markets is basically the other major indexes around the world, the DAX, the FTSE, the stocks, the Nifty, etc. Forex, and then cryptocurrency. So again, we try to provide all the analysis that you could ever want when you come here, but if you just signed up for a free trial of every service, again, it's going to be way too much information to take in all at once. So you may want to initially either just take a look at one service at a time. So for example, click on stock waves or something and just go to just the stock waves service, and you can see it'll filter out only posts from our stock wave service or any individual service you want to look at. Or if you notice there's a specific analyst you like, you can filter by that. Single analyst, follow only their posts. You can filter by only analyst posts themselves. So you could still maintain all of the different services, but filter out all those posts from individual members and only look at what the analysts who are hired staff members here, what they're saying. Or you can set up your own personal filters based on a lot of different categories that you care to kind of customize. So again, I would initially focus on one service, figure out what you're used to trading or what you're interested in learning how to trade, and kind of take it one step at a time to begin with, as far as looking at all the different analysis at once. So any educational material that you might be looking for to get a better idea and brush up your skills with Fibonacci Pinball or Elliott Wave Theory, check under our help here. There's a getting started tutorial on how to use the site. Goes into a little bit more detail than what I just went over. Intro to Elliott Wave, glossary of terms that you may see. So if there's ever an abbreviation or something that doesn't make sense, check out the glossary. We hold a beginner's webinar, which is open to all members, including trial members, every week on Wednesdays, where we take a look at the current counts on the main charts that are covered in our markets service of the site, as well as answer any questions you have about Fibonacci Pinball, Elliott Wave Theory, technical analysis, etc. And then you can also ask questions as a beginner in that beginner circle section of the site. If you go to the Intro to Elliott Wave Theory portion, click on webinars here. There's tons of different webinars to watch. Many different things that can help progress your education and understanding of Elliott Wave Theory. All right, I think that answers all of the questions that people had. Again, you should get an email hopefully tomorrow, I would say, that links a recording to this video if you want to come back and check something, or maybe you took off early because we did go over the allotted time. If you do have any further questions, you can email me at garrett@elliottwavetrader.net, or again, come check out our free trial. You can private message me or ask any of the other analysts any questions that you want. So again, I hope you check out our site, elliottwavetrader.net, if you're interested in learning more about Fibonacci Pinball and Elliott Wave Theory and how to apply that analysis to charts in your trading. Otherwise, have a great evening, and see you guys again next time.